If you're in business, the time eventually comes where you ask yourself, should I be buying a car? And if so, should I buy it through my business? Maybe you've even got friends that have bought cars for their businesses and telling you about the tax benefits. Today, I'm going to be talking about whether you should actually buy a car for your business and through your business, talking about the tax implications, and I'm going to be talking about one particular situation where buying a new car could actually cost you tax in the short term. So let's first look at the topic of should you buy a car. This is a decision I think you need to make before you even consider any of the tax implications. And it's, do you actually need a new car? Why are you purchasing this car in the first place? I've had a lot of people try and justify that they needed a new car because of the tax benefits, but I think you should be looking at the other way and first asking yourself, do I actually need to spend money on a new car? Spending money on a new car or a used car is still going to be likely very expensive. It's going to be one of the bigger purchases you make. And you need to actually ask yourself, do you actually need a car? Why are you upgrading? The reason why I say you need to make this decision separate from the tax implications is because why would you go and spend $1 to save, say, 34 cents in tax? That's the same logic with a car, but we're talking much greater amounts of money. So just ask yourself that question, do you actually need to buy a car? If you tick that box, then let's go on and talk about the tax implications. So how does buying a vehicle for your business actually impact you from a tax point of view? Now, this has changed a lot in the recent years, and I'm going to be talking about the 23/24 year and also talking a bit about what I think for future years. So we don't have the instant asset write-off limit being unlimited like we have for a while. The instant asset write-off is currently proposed to be around the $20,000 mark for this current financial year, for 24, and then $20,000 for 2025. There is some talk about it changing to $30,000 for 2024. That's a whole other topic. However, this means that for most people that are buying a new car, especially if we're talking over that $20,000, we can't instantly write it off anymore. So anything over this amount has to be depreciated. When I go through all the examples, I'm going to be typically talking about X GST when I'm talking about numbers, and I'm going to be assuming that your vehicle is being used 100% for business purposes. If it is not, make sure you do a logbook and adjust and only claim the business related percentage. So here's an example of two different vehicles and what the depreciation looks like in the first year. So in the first scenario, let's look at a $15,000 vehicle. We buy that. Because it's under that $20,000, we'll be able to instantly write that off. So our tax deduction in year one is $15,000. So now let's look at a vehicle that is $50,000. Now this vehicle is over that instant asset write-off limit. So what happens with this, we add this to what they call the small business depreciation pool. Now, assets that go into this pool in the first year have a depreciation claim of 15% of the asset value. So we go ahead and we depreciate that $50,000 and we end up with a claim of $7,500. So we can see now in year one, that asset that was only 15 grand actually had more depreciation on it than the higher purchased asset. Now, this obviously changes once we go in year two, because in year two, that asset that we purchased for 15,000, there's nothing left to claim. So there's no depreciation in year two. For that asset that we purchased that was $50,000, in year two, we get to claim 30% of the remaining balance. Now the remaining balance was $42,500, so our depreciation claim in year two is $12,750. Now this will continue to be 30% of the remaining balance each year afterwards. So this is something to keep in mind, that if you're planning on buying an asset that you think it's going to dramatically reduce your tax for this current year, that might not be the case if it is over the instant asset write-off. Now the other thing that you do need to factor in though is GST. So if you buy an asset, we say those other two assets, we'll say those amounts with the X GST amounts. So either of those assets, if they're 100% being used for business, we can claim the full GST in the BAS period that is relevant to you. So that 15,000 one would have had 1,500 of GST, so we can claim that back. And the $50,000 one would have had $5,000 of GST. Now, one other thing to keep in mind, there is a depreciation limit and a GST limit when it comes to vehicles. So you'll see these here on the screen. For the 24 year, the vehicle limit was $68,108. So make sure you go and seek advice if you're buying a vehicle beyond that to find out how that will work for you. So you can clearly see that understanding this is really important, because without the higher limit for the instant write-off, the impact in year one is very dramatically different to what it used to be. And this is one of the areas where I really highly recommend that you do go and get that personal advice. It's something my business, Rooshock Accounting, offers. We go through these situations with our clients, especially as a part of our tax planning process. So this is the perfect time for you to go and ask the questions. So if that is something that you're interested in, make sure you do get in touch with us via our website. Now let's talk about this situation where buying a vehicle could actually cost you tax in year one. So let's use the same situation where we're buying that $50,000 vehicle. But on the other side, we're actually going to be trading in another vehicle that we'd previously purchased through the business and had previously claimed. and that vehicle costs us $30,000. So you might logically think, yep, I'm spending $20,000 more on my new vehicle, so therefore I'm going to have an extra deduction. But that is not how it works, because we need to look at each of these assets separately. So we go through that same logic with the asset purchase, and that asset is $50,000, therefore over the instant write-off, therefore we need to do the depreciation as mentioned in that initial situation. Now we look at the trade-in. So what has really happened? We have sold that asset. Now, if we bought that asset in one of the more recent financial years where we were able to instantly write that off, from a tax point of view, we have $0 value for that. So we've now sold an asset that has $0 tax value for $30,000. So we now have $30,000 of income. So you now have in this year $30,000 of income and only a $7,500 deduction because of the way depreciation works. So even though you've bought a car for $20,000 more, you actually have $22,500 of more taxable income in this current financial year. Now, obviously, over the next few years, we will be able to claim the rest of the depreciation on that vehicle, the new one, but it is just something to keep in mind that if you're considering selling a vehicle that has already had all of its asset written off through depreciation in the previous years, it is going to be income when that comes back in. This is where, again, seeking that individual advice is really vital, especially at this time of the year when you're changing over assets. Changing over assets isn't something that happens every single week, so therefore go and ask that question when you go to do it. If you're spending money on capital items such as vehicles, your business is starting to take on more costs, and you're going to need to make sure you're generating enough money to be able to afford them. It is there vital that your business doesn't fail. And in this upcoming video, I'll talk about the most common reasons why businesses fail and how you can avoid them. I thank you for watching this one, and I'll see you on the next one.